You might have noticed Facebook, Meta, and Mark Zuckerberg in the news a lot recently, and it's often not good news. While the company might attract attention with flashy metaverse tech demonstrations, normally when they're in the news, it's for something pretty controversial, like the impact of their apps, especially Instagram, or the work conditions of their moderators. Despite this bad press, the company has continued to do astoundingly well financially. Well, that was until this week. So let's explain what happened and why Meta is in so much trouble. If you'd like more stock, business, and finance videos like this one on the channel, then be sure to like this video and comment the companies you'd like us to cover in the future. So, if you've got any money in stocks at the moment, you might have noticed that the stock market isn't having a great time. In January, the S&P 500 fell by 11%, from a high of $4,800 on January 1st to a low of $4,300 on January 27th, making January the worst month since the pandemic began and the worst January since 2009. The Nasdaq actually fared even worse, falling 16% in the same time period. And that fall has affected essentially every sector, apart from oil and gas companies who've enjoyed record profits thanks to the rising price of energy. Unsurprisingly, this current crash has especially hurt huge tech firms. Netflix, for example, lost 40% of their value in that period, after slowing subscriber numbers and losses of $159 million on $30 billion of revenue last year spooked investors. Twitter is also down 50% in the last 6 months, in part due to Jack Dorsey's resignation, and PayPal is down nearly 60% in the same time frame. One notable exception to this trend, though, was Facebook, or as they're known now, Meta. Meta didn't have a particularly bad January. Their stock basically held its value, which was, at least in relative terms, a pretty good performance. Unfortunately for Mark Zuckerberg, however, between Wednesday and Thursday this week, Meta's stock slumped by a massive 26%, wiping $240 billion off its market capitalization. In nominal terms, this was the largest one-day value loss in US corporate history. In fact, Zuckerberg, who owns 12.8% of the company, personally lost $29 billion worth of value. Pitying the billionaires aside, why did this happen to Meta? Well, there are broadly 3 reasons. The most obvious cause was Meta's end-of-year 2021 earnings report, released on Wednesday. But there are 2 other background causes. That Facebook was probably a bit overvalued to begin with, and that thanks to the wider market slump, investor jitters were at a new high. But let's start with the proximate cause, Meta's end-of-year earnings report. The SEC, which oversees the stock market, requires companies to file 4 reports, 3 quarterly reports and 1 end-of-year report. These earning reports are often judged by whether or not they match up to expectations. In advance of release, analysts and banks will basically set targets which they expect to see in the earnings report. And if companies don't make those targets, then the stock will usually fall in value. Now, for many big companies, the beginning of a new year means reporting season. So, on Wednesday, Meta published theirs. And, well, it was a bit of a disaster. The earnings report had 3 bits of bad news in it. Firstly, they'd simply missed expectations. The company's estimated revenue for the first quarter of 2022 was between 27 and 29 billion, below analyst expectations, who were expecting a revenue of over $30 billion. Add to that, Meta's earnings per share was also lower than expected, and this obviously all looked bad. But it was especially bad given that most of Facebook's competitors, like Apple and Microsoft, had just posted some surprisingly good earning reports, topping their expectations. Second though, Meta admitted that for the first time in its history, Facebook had lost daily active users, going from 1.93 billion in the first quarter of 2021 to 1.929 billion in the fourth quarter. Now, we should be clear that this only means that the number of people who use Facebook Blue every day has gone down. The number of Facebook accounts and monthly active users both rose, albeit only slightly. And the number of users across Meta's so-called family of apps also rose. But these numbers are often less reliable. So the fact that DAU is down, a key metric that Facebook has used for growth for years, and the suggestion that people aren't using Facebook as frequently, obviously isn't great news. The third piece of bad news was to do with Apple's new privacy changes. Previously, Apple helped Facebook craft targeted ads by offering identifier for advertisers, giving advertisers a way to track people's behavior on its devices. Now, you've always been able to disable IDFA in iOS settings, but last year, citing privacy concerns, Apple turned IDFA off by default and forced apps to ask people if they want to be tracked. And most people, it turns out, don't want to be tracked. This, though, has hurt Facebook's ad revenue, and they estimate that it will cost them around $10 billion in 2022. That's because without robust tracking functionality, Facebook's ad offering is significantly weakened. Advertisers are naturally willing to pay a lot more when they can target and track users, both things they can still do with other types of ads, like search. With this taken away from Facebook, though, their appeal to advertisers dropped like a stone, leading to a fall in revenue estimated to be $10 billion a year. And these things are only going to get worse as well. Google is soon expected to offer most Android users an opt-out for ad tracking, and plans to ban third-party cookies from the Chrome web browser. Alright, so that's the proximate cause. Meta's annual earnings report didn't go down well with investors. But even a bad earnings report usually doesn't translate to a 26% drop, so it's likely that Meta's stock slump was exacerbated by two background factors. Firstly, the stock was probably overvalued in the first place. For example, take a look at its price-to-earnings ratio. Historically, most companies have had a price-to-earnings ratio of between 10 and 20. In December, though, Meta's PE ratio was 25. Now, we should say that Facebook was by no means an outlier. Lots of companies are currently enjoying historically high PE ratios, including their competitors. But the company was, at least by historic standards, overvalued, which is probably why when the earnings report came out, investors were a little bit more spooked than usual. For reference, after the drop, Meta's PE ratio is now at 17. Things probably weren't helped by the fact that, so far, Meta's much-hyped metaverse play also looks to be a bit overpriced. When Zuckerberg first announced the metaverse plan in October, the markets loved it. In fact, they created such a trend that the term metaverse subsequently cropped up 449 times in third quarter earning calls, showing that even their competitors were getting on board the hype train. Unfortunately for Meta though, Facebook Reality Labs, which builds the Oculus Quest headset, has so far lost the company $3.3 billion. And while their research and development is obviously useful, the benefits of this metaverse play are at least 10 years down the road, so investors are getting nervous about the riskiness of this strategy. The other background reason is that at the moment, investor confidence is just pretty low generally. By the end of 2021, the stock market was as expensive as it's ever been. The Shiller PE, the inflation-adjusted price-to-earning ratio of the entire S&P, was at 38%, the highest it's been in 20 years. And the Buffett indicator, which compares the S&P's total market cap to US GDP, was the highest it's ever been. You get the point then. The stock market was overvalued, at least by historic standards. So this, plus the prospect of an inflation-induced interest rate spike, has led investors to feeling a bit jittery, which is at least in part why they reacted so dramatically to Meta's worrying earnings report. But what do you think of the whole situation? Is it a concern that Meta crashed so hard and also dented the stock market as a whole? Is Meta focusing on the right things with its push towards the metaverse? Or have other companies like Apple and TikTok really hurt the company? Comment your thoughts down below, as well as letting us know if you'd like more videos like this one in the future. Also, be sure to subscribe to the channel and hit the bell icon to be notified every time we release a new video. Special thanks to our Patreon backers who make videos like this one possible. And if you want to see your name at the end of videos, then you too can back us on Patreon. The link to that is in the description.